data. Plan today is we're going to set up trading data. What are you going to do on CPI? You're not going to go and trade it. We'll come back this afternoon and going to see what happened. Crucially, what you've got to ask yourself is how well did you stick to your plan? Doesn't matter if your plan was wrong. If you stuck to it, you can at least go, okay, well the plan was wrong. Maybe from there.
Right, there you go, you can probably hear better. Yeah, it doesn't matter if your plan's wrong and you lose money on it, because then you go, okay, well, I can change my plan. The worst thing you can do is go into it with no plan or don't follow your plan. If you don't follow a plan, you've wasted your time doing it. And if you have no plan, well, you're just punting around, which nobody does well punting around, because what you end up doing is just chasing the first move and generally buying the high or selling the low of it. That's not where you want to be. Right. Process is the important thing here. So what we're going to look at is why you would trade CPI and how you're going to go about it, and then we'll get down to the precisely what you're going to do. Right, with data, what makes data significant or puts data like what I would call in fashion depends upon where you are economic cycle, depends upon where you are from a central bank perspective. We know that inflation has been very, very important recently. You don't need to go through the economics and the explanation of it. Inflation matters. In recent times though, when I say recent times, I'm talking like last 6 months, the Fed has lent more towards the labour market as being the area of focus and less towards CPI, on the basis that CPI is falling and so therefore it is on the right trajectory. I'll show you something in a moment which suggests that today might be interesting if you get a higher CPI. What we're into, or in a situation now, is, and part of the thing that makes any kind of data point significant if you're in an environment where it influences monetary policy. And often data becomes less important when it doesn't affect monetary policy. If you're in a period where policy seems reasonably stable or it is gradually changing over time in a very predictable fashion, data's got to be miles out of line to have a great deal of impact. If the central bank is very sensitive to data, the tiniest of shifts can have a very significant impact, because that effectively is telling you whether they will or won't raise rates. So it prices in a significant amount. That's where we are at the moment in terms of probabilities for December. So it's 2/3 or 65% chance of a cut and a 33% chance roughly of no change at all. Very different to where we've been, that we were at a point where this was an absolute guaranteed cut and probably a double cut, a 50. We're now in a question of would it even be a cut? That's why today could be important, because, well, simply we may well have a situation where it indicates a cut. The caveat on today being hugely significant is we've got CPI today, we've got payrolls at the beginning of December and another CPI reading before the December decision. So it does set the bar slightly higher, that for this to have a significant impact on rates or probabilities of change, this has got to be a bit further out of line to a point where you don't think that the other two data points would necessarily turn it over so easily. So it does create a slightly higher bar. That said, markets are very sensitive. So if markets are very sensitive to it, you're going to get reaction. Two things that make markets sensitive. One, they care a lot about the data, which I think they probably do to a degree. The other thing is recent volatility. If you've got any kind of pickup in volatility, markets get far more sensitive to data, just because they're moving that little bit more, they've got that little bit more freedom in them. So that suggests to us that this is significant. The things that you've then got to decide is what market you want to trade. So it's a market structure thing, and we'll come on to this in a little bit. And there's two approaches to this. You can look at it, and I'll show you some of the previous ones. So part of deciding what market you want to trade, you need to know what's happened previously, but you also need to look at the structure in your market and ask yourself, well, what would you want to do on this data? I think if you look at something like S&P, it's quite hard for CPI to really give it too much further upside, whilst it's got quite good scope for some downside because of all the buying post-election. So there's a fair bit of vulnerability that CPI could shake out. To get this flying towards the upside, perhaps not. We'll talk about all that in a little bit. The other thing that helps you decide whether you should be trading CPI or not, and also which markets to trade and manage your expectations, is having notes on previous. You've got clear notes on previous, you've got a good sense as to the scope of movement. There's no point in hitting the S&P off the data today and hoping to get 100 handles out of it, because that's not happened for over a year. So you're not going to see that. Back end of 2022, you get 100 handles easily in a minute. You won't see that now. You probably won't even see that over the course of a whole day. So things are starting to change. You've got to manage your expectations of what you can try and get. The other thing to watch out for, and this is something people just track on an Excel spreadsheet of, I've not got an example of that, incidentally, the reactions on previous numbers or on previous instances. So you can then have a situation where you say, well, this market does the same thing every time, almost irrespective of the number. Therefore, you don't need to be super hot on your interpretation of the data, super quick on your reaction. You trade the pattern that happens. Seen this for periods in, I had one on payrolls for a while in 2016, 17 on the S&P, but basically whatever direction it went the first minute, it would flick up, pull back, and it would always break the top of that first minute candle. So you basically, as it flips up, let's say, it pulls back, you just buy, stop below the scene of crime and target break of the first minute candle. And it worked for about 18 months. You know, some of them, the first minute candle was so small because it wasn't out of line, it didn't give you a trade, but the structure worked. So the ones that gave you an opportunity worked almost every time. I've seen similar things I had a trade on CPI in the DAX, which obviously not massively related to the US, where it would just print a large doji candle for the first minute. So the strategy was then bid, offer, and ideally it would just fill you on everything. And you would trade that until it didn't work. And you end up with one of them where it went filled on all your bids and just sits there. You go, quick, scratch it, and then you don't trade it next time because the pattern's starting to change. But seeing any of those types of little patterns becomes a trade. One thing I've seen a lot this year, particularly in treasuries, is they go the wrong way first. You only know it's gone the wrong way after, but what this implies is there is a potential strategy of placing bids and offers before the number. If you get flicked in on one of them, so let's say it flicks down and you get filled long, you play it back to the origin of the move, and then you play for a continuation if the numbers aren't out of line. It's a dangerous strategy on the one that goes way out of line because it won't come back, but on the whole, it's worked quite well. It typically gives you enough time to be able to go, oh no, that's out of line, get out, because it will still flick and bounce. I'll talk about that as a strategy in a little bit. Right, the other thing that you need to do is a bit of research about what's happened on CPI recently. Now, when you're reading any data, the important thing is the expectation, not the previous. The expectation is theoretically what the market is currently pricing. If people expect inflation to be 3%, then the market is priced where it is based on the assumption it's 3%. So it's the change in the expectation, not the change in the previous that matters. What matters with previous, or why you want to go and check what's happened on previous, is to understand the trend of the data and also what is an outlier. You know, what would be a significant change and worth trading. On the month-on-month to me, market's always sensitive to a month-on-month change, but they're only ever really going to be 0.1 out of line, maybe 0.2 as a significant one. There's one example. If you go on investing.com as well, click on the data point, it will bring this up, and it's then got see more underneath, and it's got years of data. So you can see all of the ones that are more than 0.1 difference between the actual and the forecast. That's worth seeing if you want to go back and look at sort of scale of movement. But what I also want to be looking at is, well, what would be significantly out of line? If you go back over the last, well, nearly 2 years, the absolute max is 0.5, and once you've gone below 0, but really most of them are coming in 0.3 is pretty high on a month-on-month. This is headline number, which is the less important. You focus on the core first as well. So seeing as we're forecast 0.2 today, 0.3 starting to get towards top end. If you get a 0.4, that could be quite significant because that's going to put you up here. There's not all that many 0.4s. So a 0.4 would be quite significant. A 0 would be quite significant as well. On the headline is trending lower. If it comes in line with forecast though, that is going to be a tick up in the trend. That might be something that people focus on. So sort of a in line or higher than forecast might be more significant than a lower than forecast. If it's lower than forecast, well, it's still probably going to be a flat read in terms of trend, or possibly even an uptick in the trend of inflation. As in, you could come in at 2.5, which would be lower than forecast, but still an increase in inflation compared to previous. So on that basis, I think it's an easier reaction on a slightly higher number than it is on a lower number, because a higher number is one, higher than expectation, but also higher than the previous change in the trend in the direction. Because all of this year we've seen it just trend down. It's even more noticeable on the core. Core's the main one that you watch. The reason you mainly watch core is because it takes out food and energy prices, which are volatile. So you get a more sort of smooth type of movement. If you look at, say, the move down in core, it's pretty straightforward. The headline number has a bit more sort of jiggling around, if you will, in it. The problem the Fed's got is, and this is the reason why we've drifted away from 50 cut in September, 25 in November, 50 in December, is that core inflation is not ticking down quite how they want it to. They want it around 2%, it's sticking around 3%, and last time was actually a higher number. So it's not just higher than expectation, it's higher than previous. One instance doesn't make a trend, two, you've got to start thinking maybe it does. That's where I think there's, again, more significance on a higher number today than there is a lower. Lower number just perpetuates the idea of, well, we're going in that direction. It's where we thought we were going anyway. Again, on the headline here, 0.3 expected, that would be in line with previous. Anything at 0.5 would be very significant, and a 0.1 would be very significant as well. So it's fine margins on this as to how much change there actually has to be for you to actually be able to act on it. It's not like payrolls, where if you're doing this with payrolls, I'm going to be looking at that and going, right, there's a range of prices. If, let's say the number's expected 180, I want to look at that and go, well, anything up to 200 or down to 160 is not really tradable. It's got to go beyond that before you feel that it's anything more than just noise around the prediction. CPI is going to be more accurate. What you do start to get people looking at now, and I'll show you the analyst expectations in a bit, is down to the next decimal place, which gets really annoying. Because you often get a comment afterwards that it's, it comes out as 0.3, and then you'll get the post analysis that says, oh, actually it was 0.25, which has been rounded to 0.3. So actually it's not as high as you think it is, or it's 0.3, but actually it was 3.4. And so it's been rounded down, but actually it was a much bigger number. That's the bit that gets frustrating. On the face of it though, you've got to go just straight off the number that presents itself. Don't overthink it. Don't go looking into all the detail, because by the time you've done that, it's all gone.
Where do we find that detail?
Trading Economics or investing.com are generally the best ones to go for. One thing I would suggest watching though, watch the BLS website, Bureau of Labour Statistics. That's the company, or whatever they're called, NGO, who produces the data. The reason I say this, I can't remember the precise month, but it's been in the last 6 months, they printed it early. Not much, but I'm talking like 2-3 seconds early. If you happen to have been watching, your edge is enormous on that. Obviously, you've got to hope it comes out of line. So you don't want them to print early and print in line, like the one good opportunity, and they do that. But if they print early and it's out of line, you've got a huge opportunity. So watch it, it's worth watching. The other thing, I mentioned this to some of you guys, it's been talked about, on a Teams group that I'm on. Nick Timmeros, who is the Wall Street Journal Fed watcher, has consistently of late put out a piece not long after data points with his view on the impact of rates. That could be just as important as the data, or could counter the data move. So let's say you get a slightly higher number, markets start to price in no cut, and he comes out with a piece that suggests that this would not be sufficient to change the Fed's mind, you're going to see the market come straight back on it. So keep your eyes open for that. Check his Twitter page. I know that people have got an auto refresh going on Wall Street Journal website as well, to try and get that to as fast as it hits. You mainly just look at the headline of the articles. That will sum up what's going on. Right, so that's where we are in terms of data. I'm not going to go through step by step every single one of the previous, but me and Peter was talking about this earlier, as a good way of just tracking data. And I don't think it's a bad thing to do. Create a PowerPoint. Don't have to make it fancy and get nice designs on it. But if you get a PowerPoint and just put down 2024 CPI and put all your charts of every instance of CPI over the last year with crucially what happened. There's no point in having a chart if you don't know what the result was. Otherwise you go, oh, look at that move. And you've got no idea why it happened. Get down the reaction, or sorry, the result. Also, if you've got an element of context, so this is easy to do if you're not going back over it. It's harder to do if you are. If you did it today, write down the current context. This is 3 days after the election. You've got 2 more data points until the Fed. we are the pricing, we've got a situation where possibly we're not going to get a rate cut. That context gives you a sense as to the importance of the data, because when you look back at this in a year's time, let's say today comes out 0.2 higher across the board and everything falls out the sky, you then look and go, oh, I see why that's significant. It's not because it's 0.2 necessarily, it's because of one, the structure in some markets going into this, and two, the pricing out of a rate cut. That's why it's significant. If we're a year down the line, you can have a situation where 0.2 out of line doesn't really change anything. If it's expected 1.8 and comes out at 2, that's probably not going to change the Fed's view on rates. At the moment, it will. So get all of that down. I'll run through super quick, but start of the year, we were in a situation where the Fed had already told us no more hikes, and we will be cutting next year. Market thinks they're going to start in March and probably do 6 cuts. That was the expectation in January. You got a higher data point, and and this was the beginning of this flick the wrong way and back the other way. But also what was noticeable about this, or notable, is and so I try and do it always after the data. If you put your charts up afterwards, what happened afterwards is basically the market just brushed this off. You look at the 2-year, the treasuries all went down, bounced up, and then over the following days, the 2-year rally. So basically what this is suggesting is, yes, inflation was slightly higher than expected. It's not going to change the market's view, which is why you then essentially got a lot of chop in this and not the move that you might have expected. The previous year, when there was still a possibility of a rate hike, that number, particularly the 2-year, would have just gone down and like that, and that would have been it. You get a very, very similar pattern across gold, S&P, and euro. Sorry, wrong order. Gold, euro, S&P I've got in this one. I'd always get all 3 of them together. You want to see how closely they correlate, because they will go through periods where they don't. At this point, this also suggests to you that people are still very focused on inflation, because everything moves lockstep with each other. When you're going into it in more detail, I'm not going to do it here, but one of the other things that's worth doing is looking at the points when things turn, as in at what point does everything turn. So particularly on, say, this reversal back up, the S&P turns first. The grey highlights the same as the pink, the same as the yellow. The S&P turns first on this one. I think I've got the highlight on these as well. And it turns with all the treasuries. One thing I always look out for on CPI on any data point is after the data, if markets are going to turn up or down or wherever they're going to go after their sort of consolidation, typically the indication comes from the treasuries and they all kind of tick together. You see them sort of all go tick, tick, tick up. And as they all do that, like lockstep together, that's often the point where everything turns. So one to watch for. The Fed then came out after the Jan CPI and kind of went, maybe not so much on the rate hikes, and they started getting priced out a bit. So the higher rate then comes in Feb. The Fed's already gone, yeah, maybe not as many cuts, not hikes, cuts. Higher number again, so this is the second one in a row, and this one does more of what you would expect on the higher number, because now it's not being brushed off. The higher number is confirming the Fed's rationale. On ones where the market takes it very seriously, the 2-year is going to be the one that sustains the most. If you look at the candles on it, the first minute on the 2-year is then followed again by another relatively big candle and again, whereas the 30-year, the candles get quite small quite quick and it sort of tails off. On the back of that, over the following days as well, everything stayed very, very correlated, as in they all put in exact same movements. Markets took this one much more seriously. And you got the exact same in gold, in euro and S&P. This is what I would call a smoking chimney move, or an inverse smoking chimney as it happens here, where it does that and then sort of smoke like that. These are hard ones to trade unless you planned it already. To play a sort of smoking chimney, the onus is on get in within the first second minute and play for it from there. If you don't, you end up somewhere in here going, ooh, it might be a smoking chimney, and then not knowing where your stop is. And because you don't know where your stop is, you probably end up giving up on it when 5 minutes later it's still sitting at a scratch. You lose the conviction in the trade. It starts to tick against you and you start thinking, oh no, don't like it. You get out, then it goes down, and then it drops quickly and you sell it, and then it does the same again and you start to question it. And before you know it, it's all the way down here and you've done nothing apart from take a lot of scratches, a few small winners, a few small losers. And when you wonder how you've not made money. you've got to go for it early on. We'll talk about that. A lot of that comes partly to do with the significance of the data, but also the market structure as well, whether there's a potential for this. March, you've got the same sort of structure. They backed away from it. Data was still trending down on this one, so a slight difference here that the actual result did still come lower than the previous. And this is where you end up with a chop one, because it was that difficulty of the number is higher, but it's lower than previous. So the trend is still going down. The Fed has said they're not really going to cut so quickly anyway. So a slightly improved data point is not going to bring the cuts back. So you end up with this just horrible chop one. You really needed, in March, the ideal would have been a higher print, because then it really would have pushed out the whole idea of a rate cut, or a much, much lower, which then gave you a complete chop. These are the worst ones, these total chops, where it goes, it reverses the entirety and then doubles the move the other way very, very quick. So that's 2 minutes and you're back where you started. The scale of movements was still reasonable. It's 25 handles down and then 50 handles back. So the size of movements beginning of the year was still pretty big on the equities. Gold's always the bigger mover. Whether you want to trade, that's a question of how fast you think you can get in. Well, not just how quick. Gold's no faster than anything else. It's just the amount of swing around in it. If you get in even somewhere like there within the first few seconds, you're going to see yourself the best part of 40 ticks on side and quite quickly probably 40 ticks offside. It's going to be really, really fast. It's hard to get a gauge as to where you are in gold, which is why a lot of people don't really go for it. Or if they do, they go for it as a technical trade. You know, if you've got a particularly strong bullish or bearish bias on gold, you might use the data to play that trade rather than the other way around. These are the horrible choppy ones that you don't want. The treasuries do the same. But again, you're seeing this same pattern where it has this big whip and then back. The only ones that don't are the ones that are significantly out of line. The 1 minute candle doesn't entirely do that justice though, because it will still flick back. I'll give you an example of that in a bit. I've got the recording of September. April, you're on doubts over the inflation falling quick enough. So we're now in a risk of no cuts. You know, you were getting to a point where in April, May, they were pricing 1 cut for the year in December. So again, this has got to be a much, much lower data point to be able to say, yeah, they're actually going to do this. Comes in higher across the board. And this again is the more straightforward, straight down, stay down type of trade. I've actually got the NASDAQ on this one. Generally, I wouldn't touch the NASDAQ. If you think gold's fast, NASDAQ's a different level. You've got no chance of getting anywhere near, not anywhere near it, you can hit it, but having any kind of idea of where you are is really difficult to deal with. The other thing you started seeing as well, and this would then put you off gold for the next one, is of all of these, the S&P, the Euro, stuck to the move, gold didn't. Gold puts in a big, big pullback and then falls out the sky in the coming days. The difference with gold at the time, and this is where you need a more detailed write if you're writing them up, gold was sitting in a very tight range. The CPI whipped you out the bottom of the range and then everyone started to buy it. Whereas with everything else, you ended up with this sort of relatively straightforward rolling over on the idea that there's no more rate cuts coming. Treasuries, again, on the bigger numbers, the higher ones, very quick to just go, they go down and they stay down. So if you, what I kind of call the clean move, the 2 year is generally the clean one. That will go the right way, theoretically, or the higher number down, and it stays there.
Is it just the CPI or anything Fed?
Anything Fed related. If it relates to rates, the 2 year ZT is the cleanest in terms of its ability to sustain its movement. Well, the thing with inflation data at the moment is the inflation data is essentially a call on the rates. So higher inflation, rates are not going to get cut. It's tantamount to a rate hike, so the 2 year moves on it. The long end, inflation today does not affect inflation in 30 years time. So it's the long end's more to do with the overall trend of inflation, which is a different thing. So this has a greater tendency to do something different. Yeah, this is a perception of the longer end, almost a perception of stagflation, that are you going to see higher inflation and lower growth, in which case what you end up with, higher inflation causes rates to go up, you sell the 2 year, but if growth is going to be lower, you do that, and the 10 year goes back up, because if the economy is going to struggle, you're better off to buy 10 year bonds than you are to buy equities.
So the 10-year bonds are like a risk, like a safety.
View it as, yeah, it's a view on growth, the economy broadly, the longer end. The short end is a view on rates. At the moment, you care about rates. But if you have a situation where the perception is rates are going to damage the economy, you will then get this sort of inverse movement. Well, it's not inverse. What you'll get is one will go down and bounce and the other will go down and stay down. So they'll move. Take it in the first instance, they go the same way, all the treasuries. It's the ability to sustain the move that differentiates them.
In the coming days, they'll kind of go the separate ways, maybe train together. But
They can even do it on the day. I'm sure there's an example in a minute, particularly on the less clean data points. So this was the May one. Essentially, you were then at a point where the Fed's almost said we're not changing this year. So this then needs to be a fair bit out of line to change anything. Arguably, an in-line is perhaps not that bad, as in it's at least not getting worse. So it's not completely pricing the cuts out.
that's the optimal last data point.
Yeah, so the in-line is kind of taken as, well, it's not a raise in rates, so it still leaves the possibility of a cut, is the interpretation of that. In practical terms, are you hitting that? Probably not. It's in line. It's a bold trade to go, yeah, that's definitely a buy on an in line. But it was the nature of the reaction. It's not, excuse me, it's actually, sorry, I was going to say it's not the biggest. It's 30 handles on the S&P in the first minute, and then it completely dies. Gold did 90 to 08. I was going to say, surely not. Gold's done 180 ticks in the first minute. So there's a fair bit of scope on this one. The thing to take is it's a low and it's not higher. So it at least hasn't completely wiped out a rate cut, which is what everyone basically wanted. Sentiment was leaning towards rate cuts. With this one, this was, well, very quickly jump and fade, or sorry, fade out in volumes. Gold again was the one that comes back the most on it. This is the other takeaway from it. If you've got something that you want to fade, gold at this point was the one to go for, because the S&P and the euro, you saw it on the previous as well, they moved and they stuck, and that was it. Gold's the one that puts in the reverse. The treasuries, again, do the flick the wrong way. So that becomes another feature, that every time it does this flick the wrong way in the treasuries, they all generally just went up and stayed up. So this was one where it very, very quickly died off. But it was in line, so that's what you expect. This was a really interesting one. You don't get many of these. This was CPI on the day of the Fed. So this was then seen effectively as your determinant of what the Fed's going to do. If CPI is lower, this might mean that the Fed suggests a cut. If it's higher, they might not. Also, you had the dots the same day as well. So the people, members on the Fed could change their view on rates based on CPI. We learned that on the Fed because there was a whole debate. Can they change their decision in light of CPI or not? Can they change it that late in the day? Powell then told us in the press conference that yes, they can, but no one did, apparently. So that's something to know for next time, that if the data is significantly out of line, they could change. This comes in lower. So this effectively was your play on the Fed, and the Fed became a less significant Fed. With this being the case, then that proximity to the data, this is then significant, because you're always trading this. Forget the Fed. If I get the chance here, you go for this instead. Lower number, incidentally the first lower number of the year, or noticeably lower. And you get this very, very clean. On your point on a 2-year, Joey, you look at the 30 and you look at the 10, they jump and they roll back. That's an hour after the data and they've rolled back. Granted, it's not far, but the 2-year jumps and stays up. So that just gives you that difference. It's not massive, but if you think about the difference in price, they were the same, they moved up the same, and then one came back and one stayed up. The difference between the two is shifting.
Is that because the falling consumer prices is kind of, in theoretical terms, slower growth? Or the economy is slower?
Well, if you really try and sort of work it through, rates are going down, which means the economy is going to improve. So therefore, you don't want long end bonds, you want equities. So buy stocks, sell long end bonds, buy short end bonds, because these are yielding 4%. If rates are going down, you might as well lock in 4% now on a short end and use your extra interest that you're earning to fund buying equities rather than buying long end bonds. And the only reason that you want long end bonds if their rates go up to counter what you're going to make if you put the money in equities instead. But like I say, straightforward, go with a 2 year and a 5 year. They're the main ones. Bit of debate among traders as to whether you go 2 year or 5 year. Personally, I prefer the 2 year. I think it's got a little bit more movement. It's thinner because it's got an eighth tick increment. The 5 year has got a quarter tick increment. So the 5 year feels a little bit stickier, a little bit slower. The 5 year is thicker, the 2 year is thinner. There's not loads in it between the two of them. So pick your choice, pick your poison. They both would move roughly the same.
I might watch that today. There could be a play in that, like when the move's exhausted and everything's starting to slow down, you can maybe get short in just for a couple of ticks. So.
If you're going to try and do that, you need to look up spread ratios, because you can't just buy 1 2 year and sell 1 10 year. There's a ratio to it. You've got to buy double the number of 2 years to 10 years. And then there's a different ratio, 2 to 5, 5 to 10, 5 to 30, 10 to 30, 10 to 5, 10 to 2.
That's more of a hedge, right? You're gonna buy
Well, it's a spread trade. It's a spread trade
Yeah.
that what you're trying to play is the difference between the two is going to change over time. If you think rates are going to get cut really, really fast, then you buy the 2 year and you sell the 10 year on the basis they're going to cut rate and this is going to improve the economy. If the view is they're cutting rates and the economy's in trouble, then, well, you probably sell the 2 year and buy the 10 on the basis that the 10 year is going to rally because everyone's going to sell stocks. So I'll leave you guys to think about that one. Similar kind of thing. On the bigger change ones, so the more significant outlines, gold is generally the one that seems to smoking chimney more so than anything else. It seems to like it. All of them did, but the first move in gold is there, which is about 120 ticks, has a pullback and then grinds on again, basically doubles the move from the pullback. The S&P jumps, it's a reasonable move, again, there's 35 handles, and it just stays there. So the S&P is the one that you don't really want to try and hold on to or think there's going to be anything more than the first reaction. Trade that, move away from it. Gold's the one that if there's going to be a sustained move, gold's better at it.
So anywhere where people are getting away from cash or getting away from the dollar, gold is probably going to be...
Just think of it very straightforward. If the dollar weakens, gold goes up. I wouldn't read anything more into why people are buying gold. They're buying gold because the dollar is weaker, gold is cheaper. Also, technically at the time, gold was sitting in a nice range. This was a kind of flat-topped wedge and it exploded out of the wedge. So technically, you were going into this thinking, if you get the chance for a buy, gold's the one you want to go for. Whereas you look at the S&P, you could have said the same as well. The euro slightly trickier because you were always running into previous resistance. So a less attractive one. July, you then got another lower print, so more good news. This starts to bring up the hope of rate cuts and starts to hype this idea up. Same story again, treasuries jump and stick generally. You don't get loads and loads of continuation. Effectively, they price the action instantly. So rate cut, set, buy it, stick. So that's the one to go for. And you actually, in this instance, saw the longer end continue onwards rather than the short end.
We're on the longer term charts today. Is that an hourly up top?
That's an hourly up top. And exactly, if you look in the sequence afterwards, the 2 year goes up, pulls back, continues. I use the 30 year just to illustrate the extreme of it. The 30 year comes almost all the way back. The 2 year doesn't. So this is then pricing in. Rate cuts are coming now. They're coming faster than you thought because you've been in a situation of they're probably only going to do one for the year, which is what the dot said in June. Now you've had two lower CPI prints. It's starting to look good for a cut in September. Very different reaction in the S&P though. It goes up and it rolls straight over. That's something to worry about. That would then put you off trading the S&P in future on it.
Sorry, so CPI is an indication of the economy growth or is it an indication of
No.
inflation?
Just CPI is the rate of change of prices. So are things getting more expensive? And the way to stop things getting more expensive is to increase interest rates. Because if you increase rates, you don't have as much money to spend because your bills are going up on your mortgage and stuff like that. You're not going to borrow money because you're going to have to pay higher prices to borrow. So you stop spending. That stops prices going up because as a company, I can't increase my prices because no one's going to buy my stuff. So that's all it shows you.
Engage in inflation.
That's exactly what it is.
from inflation we can get a gauge on the economy growth?
Not really. No, that's a whole economics of what inflation does to growth, etc. Right. S&P then becomes a bit of a risky one on this. Very quick up, very quick back. I'm not going to try and explain precisely why. I think perception that maybe they're going to start panicking, that they haven't done enough, that the economy could be in trouble. You could speculate about all of these types of things. Who knows? But it was not taken well. Simple lesson though, like previous. If you took the S&P on the first move and went lower, buy it, get out, you're safe. If you go in, hold it, not so much. Gold, very similar. Oh, sorry, gold not so similar. Gold jumps and follows the treasuries again. So it jumps and sticks. The euro went down. It didn't go down. That's where the data comes out. It goes up, it goes middle, it goes down. That suggests to you just don't bother with the euro at all next time. That's just a complete messy chop. Leave that alone. So, but that's part of the point. You go through it and go, okay, well, I'm narrowing down my options. I don't want to touch S&P massively, although I could still go for it for the first one. I definitely don't want to touch euro. Gold's still good for a continuation move. So you go with gold. August.
Could you just follow 1 minute candle lows as a stop or something?
Yeah, that's another way people do it. You hit the first one and basically just trail behind the next 1 minute candle. Yeah, that or the problem with the EMA is your stop becomes 80% of a move back, and before you know it, you've lost everything. Particularly bearing in mind you're highly unlikely to get in at a particularly favourable price anyway. Right, August all came in line. I put this as the first of 4 key data points before the September Fed. It's not the first, it's the second of 4, because you had payrolls at the beginning of August, which is awful. Then you had CPI, then you got another payrolls and another CPI. Ultimately though, you're then at a phase where, having seen a low CPI and a low payrolls, unless this counters it, an inline number is probably seen as slightly positive. Does turn into a total chop again though. So that can kind of explain the initial whip. Again, comes back to the whole game of, if it doesn't significantly go out of line, and predominantly, I'd say more so on the upside, you get this ping up down type movement again. Treasury's very, very quick, up, down and straight back. Exactly the same game in the S&P. Like I said, you probably wouldn't want to go S&P anyway, based on the previous. You don't want to go euro either. The euro goes all over the place. It pings up, it goes down, it chops in the middle, it goes back to the middle. Messy. Don't want to trade that. At least with gold, it goes up, it goes down, it goes back, and then it trades with some degree of kind of clarity. The euro doesn't match anything else either. The S&P goes down, up and dies. So this again, if you're trading after 5 minutes in the S&P, probably not the place to be, because that seems to lose any correlation with anything else. Gold sustains movement and generally still seems to track what the treasuries do. They didn't reverse fully, but they then fell into this sideways range. On your point on reactions, look at the long end, almost complete reversal. The short end, no. So gold stays viable. The S&P and the euro start to become a thing that, unless it's out of line, don't bother with them. This was then the September. This is then the last one, and the market's expecting 50. So you're now in a situation where basically you're kind of thinking, well, it's going to be 50. The risk is that certainly a lower number is not going to give more chance of more. They're not going to go beyond anything on a lower number. So a higher number possibly takes that back a little bit, but a lower number is not really going to do anything. It'd be very hard to get them to price 75 for September. So that would be the idea. Yes, it was pricing a possibility, but you're not expecting that to be the case. So that marginally higher number does sort of add that bit of doubt about the 25. And so you get this ping down. And again, the treasuries stay down generally. The longer end's got that bit more bounce in it. So if you're going to distrust the move, distrust the long end. Even if you go as far as the first move down, this is what I mean about little nuances. That's the low on the 10-year, and it just about breaks the low. The first move down on the 2 is there. It at least convincingly breaks the low. And then it starts to reverse, but it actually goes for it and actually puts the break in. The S&P, again, first minute it does something, dies off quite quick, then it does a full reverse and reverse. Gold, again, sustains, sticks with the treasuries. Euro this time stuck with the treasuries as well. So the euro's a bit hit and miss. I wouldn't trust it. Very few people trade the euro on it, partly because it's quite a tricky one to trust. So the euro comes out, gold sticks as pretty significant, albeit with a bit of whip in the first bit. S&P fine to start with. The movement on the S&P, still reasonable. You're still looking at about 25, 30 handles. So you can still expect a fair bit in the S&P, but with a lot less convincing knock-on action. Final one was October. All of these, you're expecting at that point faster cuts in October. There was all the talk about they're going to cut quicker. We've got the election coming up. We've got all of the rest of it. They're still going to cut reasonably quick. You get a slightly higher data point. Rate cuts are coming. And it turns into a massive chop. I would have expected a little bit more sustain on that. It takes away the rate cuts. It almost kind of did that over the following days. But that higher number, you get the initial reaction and then almost a take back on the basis of it's easy to rationalise after.
Is that because the jobless maybe brought up?
There's part of that, the jobless, and the fact the Fed's looking more at employment anyway. It's a tricky one. You can rationalise it afterwards and say, look, you're still expecting rate cuts and they're still going to be a lot more significant than they were. So a 0.1 higher probably isn't going to change a lot of that. That's the rationale afterwards. In the moment, you're still trading this as it's a 0.1 higher across the board. This probably should go down. This was not a good CPI from memory. A lot of people struggled on it. Again, the S&P is the one that reacts. It gives you the reaction in the first minute. Doesn't stick it. It also doesn't reverse it. Gold reverses like the treasuries. The euro, we've seen this, the euro did the same on payrolls as well. It basically just stuck within the first minute candle. So the euro is definitely the one you want to sort of stay away from. So that's giving a bit of sense as to the reaction of all of this. So it starts getting you sort of thinking, well, if you want to go for anything directionally, you've got to get an across the board out of line, higher or lower. I think there's scope because of the pricing that it doesn't really matter which, that you could go higher or lower on that, and there's probably a trade. I think a higher number's probably more significant. You've got more to price out, and it's also a second point, and particularly if it's higher than previous, it's a second point on a trend up in core year on year.
And connecting the dots on that, meaning that if it's a high number, inflation is going up higher than anticipated, which means the anticipation of further cutting rates is now, that strategy based on the previous trend is now changing, right?
Yes.
That's going to have to change in some way, and therefore it's then, okay, so how can they change it? Well, if interest rate, if inflation is going up, then it's possible that they'll stop cutting interest rates, or the other alternative is they might end up increasing interest rates to try to get another hold. Less likely to try to get another hold of inflation, but I guess you will have one.
The end game is that you possibly end up with a rate hike, but as we're already in a situation where the doubts have come in about December, doubts are creeping in about how many more for next year, i.e. they're now looking at 2/3 rather than 4, and rather than 7, 8 was expected in September, a higher number probably leans you even more down that route and starts to really bring in the question of are they even going to bother cutting next year? So I think a higher data point is probably more significant. Lower suggests that last month was a bump in the road and we're probably sticking on the path, but there's doubts about it now. And doubts are justified. A higher number, I think, probably more significant because it then takes away, you've got 65% priced for a cut. You could see, wouldn't necessarily suggest all of that goes because you've still got more data points. But if you get a higher number, I think it takes away that possibility of a cut quite quickly and the doubts really start to set in on it. You start getting talk of, it's like the 70s, where everyone thought they solved the problem, cut rates and inflation came back and rates were even higher the next time. I really hope that doesn't happen, but.
Do you think that the inflation rate will come out to be higher the next
today? Not my job to work that out. If I
Please tell me if you know.
I have zero opinion on it.
Okay.
Completely zero. I've got no base to have an opinion. I'm not in America. I don't study it enough. If I knew, I'd work for Goldman Sachs because you get paid. If I was good at predicting it and got it consistently right, they pay me £500,000 a year to just predict the CPI data. So I wouldn't be here. Be dead easy. Do a bit of research, predict the data, bank your £500,000 a year. Job done.
Theory, the seasonality of Christmas is going to throw things off a bit, though.
Well, if you're into econometrics, go and work that out. The thing that I always say to everyone on this is there are people, like I said, paid a fortune who have got a team of analysts around them, all the data you could ever wish for, all of the assessments, research, questionnaires of people that go into this, hundreds of hours of work, and they consistently don't get it right. If you think you can get it right, either you've got some kind of magic system, in which case go and sell it to Goldman Sachs, a hedge fund, whatever, or it's just complete ignorance to the amount of knowledge you require to know this type of stuff.
No, the reason I was asking was because of Trump and the recent rally and everything in the market.
Yeah, it's, well, what you've got to remember is inflation is looking at last month's inflation, for one. You could make the argument that people would have slowed down spending, not knowing what's going to happen on the election. So it's an easy one. Whatever way you want to argue it, you could justify why it would be higher or lower. Analysts clearly expect it to be higher than previous. So there is a sense that there's an assumption that people did spend more money. Yeah, if you want seasonality, everyone got excited about, what's it called? About Halloween. And all started buying Halloween decorations, and that's what hyped the spending up. Who knows? Last thing I'd say, if you're going back through previous data, and as a way to think about how you're going to execute on this, and probably should have had a little bit more jazzy action on slides, but try and think about the data in phases of action, so that when it comes to your execution, you're not just trading the CPI data. Because like I said, with the S&P, after what I would call instant reaction and second wave, that's pretty much a dead market. There's nothing to do. So try and think about it in phases and what you're going to have to do, because your execution is going to change dependent upon where you are. First minute, the instant reaction trade is about speed. It's about, can you interpret this fast and execute what you think? So you've got to be clear on what is an executable number, and also be quick to make a decision on what market you're going to hit. If you're not doing that, second wave is then a question of how sustainable do you think the move is? Yeah, has it got something left in this? What are you going to do with that? The consolidation phase is then the bit of, is this just a jump and sideways, or is this a sort of smoking chimney, or is it a reversal? Which is why I would call it. It is sort of consolidation. You know, what's the next thing that's going to happen? Is there anything more to do with it? At the moment, this phase generally is just sideways. The data is losing energy quite quickly. So after 15 minutes, there's not much left in it. Then you have what I would call a structure play, which typically comes in once the S&P opens, where markets will essentially get on with what they wanted to do anyway, unless the data is so far out of line that that becomes the theme of the day. If a market wants to go up and this doesn't change it dramatically, then it will often then just get on with that move. So you've then got your next sort of play there. So we'll talk about all of those in a minute. Right. Execution then. So you've got a good sense as to what market you might want to trade, might not want to trade. What you've got to try and do is, when I say automate, I don't mean computer program it. I mean to have a dead straight, if I see this, I'm doing this. If I see this, I'm doing this. I'm trading this market, then this market. Be really clear on the process of what you're going to do to execute, because you don't have long. Yeah, if you want to get in for the first minute move, you probably got 5 seconds. So you've got to be real quick on that. And the only way you're quick is if you know what you're looking for. If you hesitate on it, or if you look at the number and go, does that mean it's a buy or a sell? It's gone. You've missed it. You've got to know, yeah, if that number comes out red, I am going to click this, or I'm going to click this, and you know what you're going to do.
Better to get in and just manage instead of not getting in at all.
I'd say you're better to not get in rather than get in and try and work out what's going on. Because if you get in slow, you're going to get crap prices, and then you're in a situation where this is pinging around all over you, and you won't know what to do with it. That brings in emotion. As soon as you end up with that, you end up with what I call emotional trading, of people just scrambling around because they were onside, they were offside, they were onside, they're offside. They don't know what to do anymore. So in terms of doing that, first thing you've got to decide on, based on the expectations of the number, what is your range that you're willing to trade? Now with CPI, it basically just goes out in 0.1s. Payrolls, you're going to have a wider range on these types of things. But be clear on what is far enough out of line for you to just go, I'm in. I don't really care what price, but I'm in on this. If it doesn't go that far out of line, what else are you going to do? So let's say it's a 0.2 higher. I think that's a trade where you could just go, just get in. It's going to move a long, long way. Just get yourself in. That's the most important thing. If it's 0.1 on two of the four data points, you're not going to be so bold in trying to get in on a trade, because the ability of it to sustain is probably lower. So you've got to work out what's significant. part of that comes in, like I was saying, the trend of data. I would suggest that a higher number is far more significant today than a lower number. The next bit's your execution. From an execution perspective, and I've got a little example of this coming up, you need to think about, like I said, is there a number that you're willing to just get in? You don't really care what price. There's got to be an element of reasonability in that. Yeah, if the S&P fully retraces the election, you don't want to sell the low of that. 100 handles down. What I try and do is form myself a range of prices, so I can say, right, if I can get in within this range, so below an upper band and above a lower band, I'm happy to be in. I don't care what price. If it goes beyond that point, then you've got to reassess how you execute, or sort of recalibrate, or however you want to describe it. Trade in a different way, i.e. wait for it to flick back and get you in rather than just try and hit it. The other thing you've got to think about is there a fade? There's a different way of approaching this. I'm still inclined to think that you could see a fade on treasuries on this. Certainly if it's in line, you'll get that whip and back type movement. So I'm slightly inclined to look at this and go, well, if you got slightly lower, like a 0.1 out of line on one of the 4 points, you could see the treasuries ping up and back. The slightly lower number is probably not going to change the overall story because we need more data. A higher number quickly sets you on that slippery slope towards more data going the wrong way, and it wouldn't need much more to get people really worried. The other thing you've got to think about is what's going to get you out so that you're not left panicking when it flicks back and puts you offside. It's almost inevitable you're going to go offside on these types of things. If you think you're going to get away without going offside, you're kidding yourself. You've either got to be the fastest person in the market, or you've got to fade it and catch the top of the move or the bottom of the move. That's the only way you won't go offside. So assume that you will. You've got to be clear on what's going to get you out of that trade, so that you don't panic. You don't say, oh no, it's because you'll get filled and it will whiz offside and come back. You don't want to see it whiz offside, panic and scratch it. You also don't want to see it whiz offside, panic and get out at the low. So make sure you know what you're going to do. With most of them, the most straightforward way of doing that is you look at the scene of the crime, the point it starts from, and if it jumps and you buy it here on a pullback, that's at least your nominal stop. You probably don't want it to be there, but you buy there, it will then do something like that. Now you can move your stop up because you've been shown where the low of the drop is. But what you don't want to do is just see it flick down and go, oh no, and out. Right. The other choice you've got to make is market selection. This comes down to a balance between, do you go for something you're comfortable in, a market that you typically trade, you know it well, you know how it moves, you're going to feel more confident in it. Do you go for the most reactive market, the thing that's going to give you either the largest move, tick-wise, which is probably gold, or do you go for the thing that should do the right thing most clearly, which would be 2-year treasuries? So there's no right or wrong on this. I see some people who will always trade the Bund on this because that's their go-to market for everything data-wise, and they'll always trade Bund. They know it. The Bund will basically follow the treasuries, so you can completely justifiably trade Bund on it.
And speaking about, you said on no trade markets that everyone's trading because it's too crowded. Is that when, like on Fed stock, you're trying to trade Euro markets?
Well, that's a consideration. Do you trade T-note rather than ZT, because more people will trade ZT than T-note than ZN. There's more liquidity in it. Yeah, on the whole, all of them are going to thin out massively. So there's not that much edge in that. With something like a rate cut, everyone's going to rush towards one market. With this, everyone will empty out of everything. So you don't really gain much. There's not going to be loads of bids and offers sitting in the Bund that you can just smash, otherwise everyone would trade it. And as soon as everyone trades one thing, the liquidity disappears. So I wouldn't put too much weight on that. I put much more down to what are you comfortable with, what market do you feel you know the levels, you know how it trades. Also think about how thin they will go. Like I said, they'll all empty out, but some things like NASDAQ will get so thin, it's very difficult to have any sense as to where they are. So there's also got to be an element of, you've got to be able to make sense of what's going on. One trick is to tick compress stuff. So you can do it on Jigsaw. When you click on the market selector, okay, I'll give you an example. You click on the little magnifying glass, it will give you symbol search. On there, you can change the tick multiplier. So you change the tick multiplier on NASDAQ. There you go. Now it changes it, it's only showing it by one big tick rather than quarters or halves. If you do that, it makes everything a little bit more stable in the way it moves. You have to bear in mind that if you go, I'm buying 43, you might not be filled at 43, you might be filled at 43 and a half, 43 and 3/4. So you have to, you accept the slippage on it. So you may not get ideal prices, but it's going to be a lot easier to read. Everyone does that on gold. They'll at least tick compress it to 2 and sometimes 4. I've seen some people have a load of ladders set up and they tick compress them right down. So it's almost a sort of binary buy or sell. And the idea is that you can then just hit that. It won't really move because you've tick compressed it to like 30, 40. It'll barely move. You can click and then you have another ladder next to it, which is the actual normal non-tick compressed. So that's where you see where you're in. But it makes it a little bit easier to just go bang, bang. You can then just hit keyboard market button it, just market buy, market sell. You're still always running the risk. You don't really know where you're going to get in. So there's that problem of fill, but it's more comfortable to do. And certainly if you try and do it with a mouse, you just can't keep up with where it's going. So that's a consideration. Right, in terms of expectations then, I can send this over. This is the various banks' expectations on it. There's all sorts of other numbers, and this is kind of the contributing factors to CPI, which is another reason why it's hard to work out, because you've got to understand the weightings of each of the other areas into the main number. Really difficult. There is then also a supercore number, which is often mentioned. The supercore takes out housing, it takes out a few other things. This is something that often gets brought up. The supercore is not produced by BLS. It's something that has become a thing of basically analysts working it out from the weightings of the other thing, the other components, minusing some of them. I know one of the guys trying to work on a spreadsheet to do it and sort of capture the data of BLS and print his own supercore number. The market does, so that's what matters. On the whole, I'd say ignore it because it's very difficult to control when it comes out and how people see it. The inline ones are the ones where the supercore could then flip it back. That's the horrible ones. On the whole, it's unlikely to go wildly against the main direction of the numbers as long as they're out of line. So what you've got there, that's the Bloomberg consensus. So that's the number that you're going to see printed for the month on months and then the year on year. I send all these over for you. Then you've got the various analyst estimates. The reason that what I'm looking at and being able to see all of these is to see the extent of out of line. Because as you can see, if we just take the year on year, core year on year, core year on year, 3.3, 3.4. So basically, a 3.5 would be miles out of line because no one's even gone near it. There's only 2 that have gone as far as saying 3.4. So 3.5 miles out. Equally, well, 3.2 would be lower, but everyone's kind of leaning 3.3 anyway. So even a 3.4 would be seen as higher or a fair bit of a jump. So that's something that you sort of focus on. That's why it's good to see all the analyst expectations. It gives you that ability to go, that is out of line. Yeah, that looks significantly out of line. So that's why I'd want those. I can send all these over so you can come up with all sorts of other ideas if you want.
The numbers on trading economics, that's based on what, like...
The numbers of trading economics and investing.com are likely to be pulled from either Bloomberg or Reuters. I don't know which one they do use, but that's where they'll be pulled from. So the number that the consensus number, the expectation number, is pulled from Bloomberg or Reuters. So if it's the same as these, it's off Bloomberg. If it's slightly different, assume it's off Reuters, unless they're creating their own.
And Bloomberg gets those separate from the bankers' analysis? Or?
Well, no, what Bloomberg does is it takes these and aggregates the number. It's a median average of all of the data. So that's what you're going off. Right, so the idea then is what you want to try and do when it comes down to making a decision on what you want to trade is work out what you think, what I would have is a danger zone number. I'll work this from the core year on year because my view is that's probably the most important number. You'll get a reaction off the month on months, so don't dismiss the month on months. But obviously you're looking at 0.1 either way on these. What I want is to establish a danger zone number, which for this I'd say is 3.3. If it comes out at 3.3 on the year on year, I don't massively want to jump in because yes, it might react off, say, a slight shift in some of the others, but it's got the risk of not being sustained. The year on year is the one you want to see. If that shifts, then you can assume this is the direction. On the upside, what I call trade is one that I may not be willing to just get in at any price, but I'm happy to, I want to get in on. So 3.4, there's almost nobody looking at 3.4, and an outlier 3.5 or above. So it's virtually anything higher I think is tradable. On the downside, I'm slightly tempted to say 3.2's danger zone as well. You wouldn't massively want to trade 3.2. So you've got to say an outlier is 3.1 or lower. But then the trade on 3.2 I think is a little bit of a questionable one. I don't think it changes enough. So I think you could trade it, but that for me would probably be more of a fade and more a sort of structure trade.
Just confirmation of the continuation of the trend.
Well, it's not in treasuries.
I mean, the data, like, if you look at the
Yeah, it continues the trend of the data. Well, it also, well, in the year on year, it takes the trend back down, which is the important bit. But the thing that I'd be worried about with the 3.2 is I think it's got more to do with the market structure as a trade than it does anything else.
everyone's positioning the other way.
Yeah, well, you're already expecting a cut to a degree. 3.2 is not going to nail a cut on because you've got more data coming. It's also not going to bring in any doubts that they won't cut. So I don't think that has so much significance. 3.1 or lower very much gets you down the road of we're going the right way. Last time was a blip. Move on. It's all good. Rate cuts are coming back. 3.2, if it's in the S&P, might be enough to just go brilliant. It's not higher. We can keep on buying. The treasuries are a harder trade on a 3.2 because the treasuries are trending down. It's probably not enough out of line to really change the trend. So this is why I say it's a structure trade. That's going to be a tricky one. 3.3, don't massively want to trade that. Anything out of line, I think, creates quite a significant shift. So that'd be the way that I'm trying to think about it. But you know, the point of doing this is to do it for yourself. If you're not super confident on hitting the data, then your danger zone becomes, say, 3.2 to 3.4. And then you're only going to trade a 3.5 and you're only going to desperately jump in on a 3.6. So you can vary it yourself. You know, and that comes down to your own confidence in your ability to trade it. I would suggest for today, go for it on whatever, because you know, you're trying to learn from the experience of doing it. Even a 3.3, I'd say go for it, but just try and fade it would be my general approach on a 3.3. Particularly in markets that have got a direction that doesn't suit a lower rate. So I think a 3.3, yeah, I'd back down on all of them. I think you could just fade 3.3. That would be my play on that. So that's the way I try and go through that, just set up what you're willing to trade. The other thing is an across the board number. Don't want to go into the permutations because obviously you've got 16 different permutations of one's higher, one's lower, one's higher, there's two higher, two lower, et cetera, et cetera, et cetera. Well, you just end up with too many options and then you won't be able to work out which option you've got. So
We're just focusing more on the year over year and the month.
I would look on the core year on year and month on month would be my main two to focus on. Ideally, for a trade, you want to see them all go the same way, like all higher or all lower. That's what you really want. If you don't get that, then you've got it brings some doubt into the move, if you will. Right, this is what I was talking about in terms of execution zone. Having an area where you go, right, and there's no point in doing this now because we're too far away from the data, you don't know where market's going to be. I would suggest do this at most 15 minutes before and at least probably 5 minutes before. Get a chart up of whatever you've decided you're going to trade and look for the most recent high, recent low, so that you can say, right, if it comes out, I don't know, let's say slightly higher, you're trading S&P, you go, well, that's the recent low on my 5 minute. Doesn't matter what price you get as long as it's higher than there. Because the idea is it will break that. You know, think about it with a little bit of reasonability as well. If I bring you up an S&P chart, I'll go on a 5 minute. If recently it's been going 30 handles, right? We're trading O2, typically goes about 30. So you've got 8 handles to 10, and you've got, what's that? 10 handles to the low. That would be my range on the basis that escaping this, you've probably got another 20 to the upside. So you could have a target up here, and escaping this, you're at least going for the low. If it breaks the low, this could be the beginning of a bigger move down. So I'd look at that and go, I don't really care what price I get, because the assumption is it will break either of those edges. That's the idea of that range. If, let's say, it goes down and you can't get it before it reaches 93, then you reassess what you're going to do. You have to question how willing are you to hit this. If it's a 3.5, I would say if you can hit it before 86, it's still worth hitting. If it's a 3.4, you might want to see if it can flick back and then sell 92. So that's the whole idea of it. So that, again, you're going into this and what you don't want to be doing is looking at a chart as the data comes out. Know the points that you're interested in. Write them down. I always used to have this. I would write them on a post-it note and stick it to the bottom of the screen so that I knew, and like under each market, I'd have levels on S&P, on gold, on whatever. Got all your levels marked out, so there's no need to look at a chart. You know where you are. So do that. That's how I'd do that. But go pick the market you're going to trade and go and break them down like that. The other thing, if you're going to have a go at fading anything, so particularly the treasury flick trade, then you've got to look, I would look more at an hourly to do this and pick a point where I'm going to go, okay, if it flicks that far, then I think it's probably worth a sell or a buy. On that note, I'm looking at a 2-year. I think if you can get filled up there, or get an offer up there, unless this is 0.2 out of line, I would expect to see that flick up and dip back. I think that could be quite a reasonable trade or a reasonable attempt at fade. The considerations with a trade like this is, if you go too far, the only way you're going to get filled is if this is miles out of line. Therefore, you don't want it. You know, if you go up here, let's say, the only way you're getting filled on that is if this comes in at 3, in which case you do not want to be short there. You've got to have this balance of far enough that you can get filled and it will actually give you a reasonable chance of getting out. You don't want to go too close, because if you guarantee a fill, wonderful. But if this doesn't come back, or it doesn't come all the way back, you're probably not getting far enough on side to justify the risk. Because the risk is, this is out of line, it fills you and goes straight up. So whilst it sounds easy, and when it works, it's perfect, because it goes ping, before you know it, you're on side, all good. If it doesn't, if you go too close, you're in trouble. If you go too far away, you're in trouble. You've kind of got to look at it and go, well, what's a decent resistance point? You're also partly playing on the idea that if anybody does buy it, what are they going to be very happy to take? You know, if someone buys this on a 3.2, 2-year jumps up, are people going to look at 26 and go, yeah, that's probably good. I can have that. Take your profit there. So that's the kind of idea behind it, if you're going to try and play that fade. But pick your levels off an hourly if you're going to try and fade it. Or well, certainly if you're going to try and fade it instantly. If you're not going to do it instantly, then it's about looking for a structure to try and play back. The S&P seemed pretty good at that recently. So this would be one where you've probably got 2-3 minutes to reverse it on the S&P if you're going to play for that. It doesn't seem to sustain the movement. So if you're going to play a reverse, you've probably got a couple of minutes. That's where a footprint will be helpful, because it will give you that little range after the data to play the reverse from. Right. One thing on algos, don't worry about algos. They're very good at beating you to the punch. They will be faster than you. You have zero chance of being quicker than the algo. The only chance you've ever got of being in before the move starts at the best price is because you've accidentally clicked before the data. That's a total coin toss as to what happens there. Also, don't try and do it with stops. I explained this one the other day. You try and do it with stops, this could turn into an absolute disaster because you get filled before the data's even come out. Don't worry about that. What algos can't do is they can't trade technically. Someone can input to what is a significant level, but the algos can't necessarily trade technically, so to speak. They also can't interpret significance. I can do spoofing all day long. They can't interpret significance. So what they can't do is understand the ongoing implications of this data. If this is higher and you get a continued sell-off in the S&P, the algos can't interpret the significance of that. I'm sure they're getting smarter, etc. But there's an element of what algos are good at, and you've got to think about this from the point of it's very mathematical, right? Algos' objective is one, to win at what they can win at, being fast and also reducing variance. So this is quite a simplistic view, but one of the things that will happen is if on a piece of data the market shoots down, the algos will beat you to that. But what an algo wants to do, or what a computer system's going to want to do, the longer you stay in the trade, the more things could change the outcome of the trade. Market interpretation can shift. people's positions could change. You don't know that somebody, if you've sold it, if the algo sold it here, you don't know that they've sold it and someone goes, we really want to buy this, and just hammers it up the page. So the objective of an algo is to reduce the variance of what can happen. Fast in, fast out, that's going to happen almost every time, and you could model that because the only other people doing it are the other algos, so you can be faster than them or try and compete speed-wise. What it does mean as well, though, is when the market flicks back, a lot of this is algos banking profit. That gives you the chance to get in. This is why on data nowadays, almost every time you will see some degree of flick back. So there's not so much value, or there is no value in being the fastest to interpret. The flick back's not necessarily slow. Yeah, I'm talking this could be 3 seconds, but that flick back will be enough for you to be able to get in. There's almost some value in being slow now, that it will go down. You go, oh yeah, look, click, and it comes back and fills your offer. So if you're slow, you can actually do better off out of it. The last thing you want to do is chase the first move. That first low or high, whichever way it goes, that is absolutely not where you want to get in, unless it is miles out of line. You know, if this comes in at 3.5, it might be worth going, yeah, I don't mind, because the move down is going to be so big. You got this in 2022, where because the markets were so reactive to the data, you'd see the S&P would drop 50 handles instantly, and you could sell the low of that and still get 20 more, and it was worth it because it had no ping back in it. Nowadays, if you try that, I think you'll be in trouble and it will ping back on you. So just think about that bit. The other thing is, there will be some algos that will play these as mean reversions, i.e. it can't go that far that fast without a bounce. They buy for the bounce, and if it doesn't, because they can't interpret the significance of the data, then they run into a load of people who sell it. And the good thing about algos is they're not hopeful. They don't hesitate. If the computer says get out, they just sell, which can perpetuate a move. You know, they're not going to kind of assess the liquidity and go, well, maybe not today, or maybe this data point actually could reverse. They're just, it's wrong, get out, and it will sell. So it can accelerate a move. So they're not that bad. Right, a quick bit on structure in terms of what you want to trade. So that's the significance of the 86s. I'm looking at the S&P, and what I'm thinking on this is, this has got a lot of upside, or it's very, very bullish, right? Everyone thinks it's very, very bullish. There's also a lot of people who are long from down here, and here, and here, and here, and all in here as well, all thinking this is going to go up. So I think there's a fair bit of vulnerability on the downside, that you've got lots and lots of people who are possibly holding and holding and holding post-election, hoping this turns into something massive. How far down is this going to go before people really start giving up? You've now had 1, 2, 3 days of sideways action. It's almost a head and shoulders as well. The more shorter time frame people, I don't think will hold on below 86. You could see quite a quick rip down from there. So I think there's a vulnerability in the S&P to at least the first move being quite big and quite fast if it breaks 86. The sustain of that is then the bit that you're going to have to try and work out, but that's your second wave trade. You know, your belief in the sustain. If it's a 3.5, I think this could be more significant. I think you could then get the drop, pull back, and then it goes again. When I say I'm talking, that's going to be a sort of 15-minute move at the next leg, but you need to see everything else do the same and go for it. Upside on the S&P, I don't like the look of it that much, but I think there is an element of it's really bullish, people want to buy it. Anything that's not that bad might be sort of a steady move. This would be one I'd look at more of what I call a structure play, that it might be a case of, if it doesn't go down on the data, then come the S&P open, we've had the consolidation, this is the chance to go up, and we could then keep on going towards the upside. That would be on my sort of main thought on the upside. I don't think there's much, if you get a lower number that's that attractive in the S&P really. That could be wrong in the sense that people go, anything that's not higher is just a buy, and they'll just buy it. So you've got to make that decision. Yeah, on that basis, like I said, if you've got 13 as a level, if it gets over 13, you could kind of play it on the assumption that this will just keep on drifting. Based on recent form on the data, I wouldn't go with that too much because it seems to just die off after 15 minutes. So I think there could be something on the upside. You might get a quick move up to here, and then it's a case of waiting and wait for 230. The downside, I think, is where the bigger potential is for the S&P. 2 years quite tricky because a higher number obviously prices the rate hikes out. So theoretically, a higher number I think is probably a more significant number. The 2 year is already on a massive downtrend at the moment. So how much does a higher number continue that? That's the harder bit. But it's hard for me to see a lower number being that significant on the upside. So as a choice on 2 year, I think my choice would be to try and fade it from there. That'd be my main plan. Try and fade the upside, because I think if it's slightly lower, I don't think that's enough to get people thinking more rate cuts. It might move us towards pricing in the deck rate cut more, which is what we all ultimately still think is going to happen. So I don't think that offers too much significance against the general trend. A larger move is the difficult question of, well, if you've come this far, can it really keep on going? It's probably a better one to look at it from a yield chart. That's where you are on yields. You look at it like that, there's not much that gets in your way on the upside there. So you could look at that and think, well, there isn't too much to suggest that it can't just keep on going. That's a daily, so don't expect to see some kind of candle like this up here. But there is a pretty significant potential on this. So I probably lean more towards downside if you're going to do anything. The 2 year is almost one where I would view it as it's a sell whatever type trade, which I quite like. I like those ones where you can go into a market and go, right, I'm selling this. Doesn't matter what happens, it's a sell. You're either selling the pullback or you just sell it through the low on the data and treat it like that. The only one that I think the danger zone, the 3.3 or 3.2, could do what treasuries have done a lot and just massive chop one. So 3.4, I think the treasury is a good sell. Anything else, I think it's probably a good fade on a ping around, and I wouldn't be so confident of selling it then. Euro, I think, is quite nice either way, personally. It has got the treasury element that is sold off and sold off and sold off, but I think the euro is reasonably good either way. You've got a double bottom, so if you fancy the move up, you've got a double bottom and you can play there and then there. If it goes and breaks the double bottom, it's the next leg down. So I think the euro is probably quite attractive whichever way you want to go. So if you want something that gives you options and you go almost whatever happens, I can click the euro. 2 year, I think, is more directional bias to the downside. S&P is more directionally biased on a higher number to the downside. Gold, I'm a little bit unsure on, to be honest. I think gold, probably like the euro, you could say it's either way. Draw it as a pennant and go, well, it would be fair to assume we could take back some of this drop. Bear in mind, gold's done a massive drop. So I was talking about 26, 23 as a potential target, and it's done another 300 ticks through there as well. You could argue on the it's a bit tired, and there's going to be a lot of shorts who could profit take it back up. But technically, that's a really nice continuation as well. Seeing as gold's been the one that has more continuation than anything else in it of late, gold, I think, is probably the one that you could go and believe in a bit of continuation. At least continuation big enough to be significant. You know, even if it only comes there, that's still from where you are at the moment, 300 ticks in gold. So I think there's scope in gold more so than anything else. Gold, the more you think about it, probably the more attractive. It's the point of going through these things and thinking it through. You go, actually, perhaps I like gold quite a lot. So there you go. That's how I'm going to do it. Go through your markets. Ultimately, if you're somebody who's gone, I'm trading S&P on this, I don't care, trade S&P on it. You know, don't change that. Stick to what you want. I'm going to go through it step by step. But it's a good thing to just draw out a table, because if you can draw out a table and go, right, if this is a beat, I want to do X, a miss, I want to do Y, inline, I want to do Z, you might find that something like gold has got to trade whatever. You might find that actually I probably only want to sell the S&P on a beat. There's no trade on a inline, and it's a sort of scalp trade on a miss. So you might then go, well, there's only one trade on the S&P. I think gold on a beat is a sell. I think gold on a miss is a buy, and both have got decent scope. The next thing I would do, once you've decided which market you fancy, then go through and mark up your levels. So where do you think gold's going to go on a miss or a beat? So that, again, when you hit it, make this relative to what's happened previously. There's no point in going, oh, well, if this is a beat, gold's going to go 700 ticks, because it won't.
You mean the number comes in higher? Or?
Yes, sorry, when I say a beat, I mean a higher number, a miss, I mean a lower number. But term it how you want to term it, as long as it makes sense to you, term it like that. But yeah, that would be the process for which I'd do it. Go through, what you're going to do on a beat, what you're going to do on a miss. If anything, you don't have to have an answer. If you don't have an answer, that tells you part of whether you really want to be trading this market. You can have situations, I do this, a fair few other people do this, where you go, right, if it's a beat, I'm trading S&P. If it's a miss, I'm trading gold. And so then you make your decision there. So it's either a buy gold or sell S&P trade, and then you decide based on the result. So you step it through like that, then you decide what you're going to trade, and then you get your levels marked up. I think that was the last bit I was going to put up. Yeah. So I'll let you guys go and think about that. I'll send this over for you so you've got the kind of all of the previous's, and then I'll leave you guys to kind of work how you're going to do that, or just write it out yourself. Typically it's easiest to just write it out, so you just write down the levels. Get a plan together. Most important thing on the data, stick to the plan. If you don't stick to the plan, well, one, there's no point in doing it, and two, you're going to get completely lost really, really quickly because everything will fly around all over the place. So there you go. The one bit I had got this one up. This was the September data. I hadn't got a video of the October one, but this was this one on the September. So this was the one that was only marginally higher on the data, on the results. So it's only a tiny bit higher, but you still got quite a decent reaction on it, which personally I didn't think was really that justified. My view on this was you've got a fair bit of time. There's no real justification for why this is going to change things a great deal. So you've not got much time. It was coming very, very soon. This isn't going to change things a great deal, so it should be a fade. You actually got this sort of pretty solid drop and bounce. But the idea of the trade on this was playing and it also illustrates that you can do it, playing the fade on the treasuries. There you go. No, doesn't like it today. No, okay. So one last thing on ladders, the way you'd set them up. I'd set up 30-year, 10-year, 5-year, 2-year, and then I'd do S&P gold and euro. That'd be the one thing to do there. The other ones over here, I've got ZQs, so that's Fed Fund futures. Decent gauge they are for what's going on. So if you see them move significantly, more so than a 2-year, Fed Fund futures will go bang, and that's it, and they will just move. That's quite a useful gauge. If you see them drop quite significantly, pretty fair to say, yeah, this is a big deal. So that's one approach to it. They will thin out massively. Typically Fed Fund futures is 5, 10, 30,000 bid and offered, and then it goes down to single digits. This would be the kind of thing that if Timoros puts out a tweet, what you can have is, let's say everything goes down, the liquidity comes back, Timoros tweets, you could buy 2,000 ZQs and take 5 ticks back out of it. So that's the way that people will approach it. I have seen your questions, Darius, so I'll try and answer those in just a minute. Right, so the approach on this, the plan on this was basically to bid the 5-year for a flick down on the basis that a marginally higher data point isn't really going to change. So that's it, drops, get you busy. When it's real fast, it might not show that you've got filled instantly. The idea of this then is once you're in, it should flick you back on side. So even though this went down, within that first minute, you're still going to get some degree of bounce in it, which is also important to bear in mind. If you were trying to sell this, you get the chance to sell. So this is the kind of thing that you can't really capture on a chart. But if you've recorded it or you write up on it in future, just simple, it starts here, how far does it drop and pull back? So that you know that, well, if you did want to sell this, you got that fair bit of space to try and have a go. That was about 10, 15 seconds from the low to back up in this area before it then starts to go again. So it does mean that you have that chance, that you've got the time to do it. Not saying you have to fade everything, but if you're going to try and go with it, expect to have a little bit of a chance on it. You don't have to be the quickest person. Equally though, it's easy on the pullback, or it seems easy when you're in down here and you're not too focused on the precise point of the pullback. If you're trying to sell that, you will almost inevitably go offside because you're not going to get it perfect. It will flick up, you go, sell, and it goes tick, tick, tick up a bit more. So don't try and be perfect. Back the idea you've got. If your idea is this is a sell, well, the scene of crime was wherever it was up here. As long as you're below that, it's still a sell. Sell it and keep your stop up there. So you have to accept that bigger tick risk on it, but that's the way that I try and approach that one. And then you just have to be clear on where you're going to give it up. If I'm looking at something like this, you've got that 1,000 lot down there. If you're going to try and get out, that's where you get out. Right, I'll answer Darius's questions quickly. Can you explain a little bit more about situations that could lead to a large pullback in the S&P after CPI data that could lead to a move that holds at a new price in either direction? Not having an easy time picking the most relevant info though. On that, Darius, I would just, like I said, I'd plan it out. Hopefully I'll probably answer that one through the session. So hopefully that's reasonably clear now in terms of, for me, just think about the vulnerabilities in the market. Where are people vulnerable? I think people are far more vulnerable to a downside move. So 86 for me is a really big deal in the S&P. Also, is it reasonable to suspect that if the move does not fully turn and go entirely in the opposite direction from its starting point, the initial move is likely to indicate direction of the day? No, I would, like I said, treat this in phases. Whatever it does in the 15 minutes of and post the data, leave that to what it is. If it moves you to an area that is past the point of no return, 86 in the S&P, let's say, then that can have significance. If the S&P just chops around and stays between about 90 and 15, then I think you're waiting for the S&P open, and that will determine the direction. It's not that often that a data point completely determines the direction of a day. Often in the S&P this year as well, even if you get a directional data point, it turns it on the S&P open. Right, last question. How much slippage on a stop loss is realistic in S&P if I enter a position before the data release? The premise being that I think there's a lot more scope on the short side than the long side. And would it be a realistic strategy to be short with half my size or less, no stop, then if it goes up, add and try to get out with a little to no loss? You could do it. I get the rationale on that if you're gonna get a downside move, it's probably gonna be bigger than an upside. You've just got to think, if you're gonna sell 98, I think your risk on it, rather than think what's a reasonable stop, if you put a stop in, you run the risk of getting flicked out of it and you've lost for nothing. So to be confident, if you sold this before the data, to be confident of not getting stopped out, I think your stop's probably got to go up there about 38. So you're taking a 40 handle risk on this. That's $2,000 a contract. I wouldn't fancy that very much at all. You've got to then ask yourself, what's the upside of that? You've got to be very sure this is going to go at least 40 handles down to justify that risk. There's a possibility, let's say this comes 0.1 higher on the month on month and everything else in line, that the S&P goes down and everyone goes, brilliant, buy the dip, ping straight back to you. So you'll never get 40 handles out of it. I don't think it's a risk worth taking. Back yourself that if this is a higher number, you'll get in before 86. That's all you've got to do, get in before 86 and it's good. I wouldn't want to go into this beforehand, because the problem with doing anything like that, and it's the same game with stops, when it works, great, because it will go far enough to justify the risk. Unless this is decent out of line across the board, almost every other scenario will not pay you enough to justify the risk that you take, and many of the scenarios will actually cause you to lose that money. Or at least, even if you don't lose, you go short into it, it trades up here, yes, it doesn't stop you out for 40 handles, but it doesn't come back. Now you're still taking a 20 handle loss. So you're basically betting on the 10-to-1 horse, but also taking the risk on basically laying the rest of the field, if you will. I won't go into it too much, but you're taking quite a big risk to bet on the outlier potential trade. That would be my take on that. Have a go. Yeah, at the end of the day, you're on a sim, experiment with it, have a go at it. But don't take it if it works to be, yes, this is the solution to data. But have a go, see what happens. Right, I'll leave you guys to have a little think. Send your plans in if people are feeling brave enough. At least then it will keep you accountable and you'll do what you said, rather than send your plan in and I go, oh, so how did that get buy in the S&P go? And you go, I sold it. What are you doing? So yeah, have a go at that, Darius. See how it goes. Right, I will see you all. We'll probably come back at 2. If it stays, everyone's still trading it, then we'll perhaps leave it till 2:15, 2:30. So I'll let you know on the group if it's gonna go a little bit longer. Hopefully it's a decent mover. You can never guarantee this, which is always the downside of doing all your prep. You do your prep and you get paid nothing for it. One last caveat on that, or one last thing on that. Don't feel you have to act because you prepped. Which is the danger that people have. They do the work, they're like, right, I plan this, I'm gonna do this and this and this, and then it comes bang in line and they still feel they should do something. Just because you've done the prep doesn't mean you have to trade it. Right, I'll let you get on with that and I'll see you about 2 o'clock.